Okay, after we dispose our assets, let's see the last options that you have to exchange one asset with another asset. That exchange is called non-monetary transaction. Cash is not involved. We're just replacing one asset with another asset. The only thing that you have to be careful is to check, is there commercial substance? If it's yes, one rule applies. If it's not, the other rule applies. What is commercial substance, you're going to ask? Well, commercial substance is when one asset is significantly different than the other asset. Usually, we treat them that there's no commercial substance. If there is no commercial substance, then the new asset that you're receiving, replacing the old asset. So in that case, you record it at the book value of the old asset. In that case, there's no gain, no losses, nothing. That's the very simple thing. And that's the simplest way. You to replace one asset with another asset. Well, if there's a commercial substance, that means one asset is significantly different than the other asset, and the cash flow that you receive is completely significantly different than the cash flow that you're getting from the old asset, then you have to follow different rules. What are those rules? Now, the new asset will be recorded at the fair market value. Then the old asset is moved out from the books. Amortization related to that asset is also removed of the book, and you may have gain and loss. So in that case, you're going to experience gain and loss when the exchange of one property, plant, equipment, asset for another property, plant, when the transaction has commercial substance. Why? Because you experience significant change in the risk, timing, and amount of the future cash flow. Again, one asset is completely different than the other asset. You're exchanging zebra for chicken. Significantly different one than another. I'm just using those ones so you can kind of picture one and the other. Now let's see the example. Let's assume that a truck with a cost $42,000 with accumulated amortization up to this point $30,000 is exchanged for the new truck with the fair market value of $53,000. You're getting trade-in and allowance of the $8,000, and you're getting cash $45,000. Now, in this case, we have commercial substance. What are we gonna do? First thing first, we have to follow the logic here. You have to ask yourself, what they get, what they give up. What did you get? We get a new truck. What's the fair market value of the new truck? $53,000. Now the question is, do I have to pay $53,000? No, I have to pay only $45,000. Why? Because I'm getting allowance of $8,000. So the cash that you're paying is $45,000 only. So let's record the new truck, $53,000. We're paying $45,000 cash. Okay, after we get the new truck, do we still have the old truck? No, we don't. We exchange it. So the old truck has to disappear from our books. So I have to credit the old truck and remove it from my books. Once I do that, once the old truck is gone, any accumulated amortization related to that truck, it's also gone. So the $30,000 also gone. And at this point, I'm going to start doing calculation. Am I losing? Am I gaining? What exactly is? In this case, we're losing $4,000. So what you have to do next time, make sure you get more trade-in allowance. If you have got, let's say, 12,000 trade-in allowance, you'll be neutral. No gain, no loss. Does this make sense? Okay. So let's see internal control. Internal control of the property, plant, and equipment, since we're talking about the assets which are important to our company in terms of having those assets to generate revenue, we have to safeguard those assets. How are we gonna safeguard those assets? By assigning responsibility for those assets. Obviously, we can do some insurance, so we can do some protection for the assets from the losses. We can hire some security people who's gonna safeguard the assets. Long time ago, I'll tell you how long time ago, back in the socialistic time, the people in that case, when everything was government property, how the government, what kind of tricks the government using to protect the assets. It was very simple in that time because every asset is given to a person. Now, the person who using the asset, he's not responsible for the asset that he's using. In the contrary, he's still responsible, but not for the asset that he's using. He's responsible for the asset that somebody else is using. And that makes it more interesting because if I damage my asset that I'm using, I don't have to pay for it. They're going to deduct it for my friend's salary. And uh, if my friend damage his asset, you don't have to worry because they're going to take the money from my salary. And that's how they protect assets, by making somebody else responsible, not the person who's using the asset. You may say that's not fair, but technically it was working and the assets was okay. And people were caring about the assets. So let's see what we're going to do with the natural resources. Well, the natural resources, the interesting part with the natural resources is they're, they're not recoverable. One is always over. What that means is using the term amortization for that asset might not be the proper way. What will be the proper term for those assets, the natural resources? That will be depletion. You have something, and after 100 years, you have nothing. You find the oil, great. After 100 years, you extract the oil. Is there anything left? No. You have a coal mine. What's going to happen? You're going to explode that coal mine, and at some point, that coal is going to end. No more resources. So what you're going to do, you're going to find another coal somewhere else and it's going to start digging again. So you have it, you extract it, and after that don't have it. Can you recover? Maybe after 25 million years. For those of us who's gonna still be around. So how are we gonna calculate the depletion or the amortization of total resources? Same, exactly the same. But for those one, we're gonna estimate what's the capacity of that natural resource. How much we can extract, how much oil we estimating that we have, how much ore we think we have, how much natural gas we think we have, and based on the residual cost and the residual value, we're going to start amortizing every time when we're extracting that out. So assume that the oil cost is $300,000 and contain estimated what 10,000 barrels of oil. So what we have to do, we have to come up with the amortization rate, which will be $30 per barrel. So every time when we're extracting oil, we have to transfer into amortization the amount related to that for every single barrel that we extracting. In this case will be $90,000. Easy calculation. The journal entry will be exactly the same like before. Amortization expense debit, create accumulated amortization. What's going to happen if we have a future removal and site restoration? Most of the contracts, especially for the natural resources, especially when you sign a contract with the government to explore the land, to extract the oil, extract the ore, or whatever you're extracting, there's a contract that says at the end of the period or end the resources are gone, you have to bring the site to the site's original condition. I strongly suggest you, if you have a chance, to go to some mine and see what exactly they're doing with the land. You won't believe it. It looks like something. It's interesting to see it. If you have a chance, go and check. It's very interesting. So now imagine whatever you see, they have to bring it to the original condition that was before they start any excavation and any work. And sometimes that's a huge cost. Let's go with the one of the last thing that will be the goodwill and intangible assets. What is goodwill and what are the intangible assets? Now the goodwill is difference between the purchase price and the fair market value of the company that you purchase. Goodwill is created only and only when two businesses get together and create one company. Now, intangible assets is something different. Let's focus now the slides going first with tangible assets. Let's focus on the intangible assets, and after that, we're going to talk about the goodwill. Now, those are the assets, intangible assets, including the goodwill. They don't have physical form, physical substance. You cannot touch them, you cannot smell them, you cannot see them physically. You can have a special rights from the ownership on the patent, copyrights, trademarks, franchises, leaseholds. In that case, amortization is computed over the lesser of the asset's legal life or estimated useful life, whichever is lesser. Now, amortization can be written off directly against the intangible assets. And in this case, there will be no accumulated amortization account. So every time when you have amortization, you're writing off and you're reducing the amount of the intangible assets directly. Can you have intangible assets with indefinite life? Yes, you can. In that case, those assets are not amortized. Patents depends on the year, for how many years you sign the patent. Over that many years, you have to amortize it. Assume that the company paid $2 million to acquire a patent, which is expected useful life will be 5 years. So what you have to do? Over those 5 years, you have to transfer the cost of the patent into the expenses as a amortization expense, and that's going to start reducing the costs, the patent which you're keeping on your balance sheet. Probably the same thing is going to happen if you sign a contract. Let's say you're Al Nasser and you just sign a contract for 2 years with Cristiano Ronaldo. You have to pay him 200 million British pounds per season. So what you're gonna do? You're gonna put it as a asset in the beginning, and every month you're gonna transfer from the cost, from the value of that asset into the expenses, appropriate amount over the 2 years. Don't forget, every year you have to transfer 200 million pounds. We may have a specific intangible assets, which are copyrights. Copyrights are exclusive rights to reproduce and sell software, books, musical composition, and other works, trademarks, or franchises. Also, specific intangibles are leasehold rights. This is the right of arising from prepayment for the leasee makes to secure the use of the asset from the lessor. For the leases, we're going to have a separate discussion, or maybe not in this course, but people who's going to continue with accounting, they're going to have a different discussion for the leases on the intermediate financial reporting. The other specific intangible is a goodwill. The goodwill simply represents amount paid over the fair value of the assets when one company purchases another company. Goodwill is only and only recorded when again one entity acquire another entity or another company. What usually the one company is going to buy from another company, that will be the net assets, which will be assets minus liability from the accounting equation. Once you check the assets, let's say the book value of the assets is $100,000 and you have liability. The company has a liability of $20,000. So the net assets are $80,000. That represents the equity or net assets, either way. So the other company decide to something that's sitting as a book value $80,000. They decide to pay. They negotiated to pay $120,000. Now, once the company pay $120,000 for the net assets, the book value is it's a good thing, but at the same time is not that good thing because the book value doesn't give you the real picture of what you purchase. Then the purchaser, the purchasing company, is going to have to come up with the fair market value in order to record those assets. And they're going to record the assets at the fair market value. The question is, is the $120,000 that they pay for the assets of 100 and liability of 20, which is net is $80,000. When they come up with the fair market value of those assets and liability, is going to be more than 120 or less than 120. If it's less than 120, the company pay over the market value, and that creates a goodwill. Again, that's the only way you can create a goodwill. Can the purchasing company generate a negative goodwill? Yes, it can. How can we generate a negative goodwill? When you purchase something that's fair market value is $120,000, but you purchase it for $100,000. So you're paying less than the market value. And that's how you're creating the negative goodwill. And we're done with this chapter. There's this here example of the goodwill, but I'm not gonna bother you with those goodwills. One thing that I don't think we covered, but we have to cover that part in order for you to complete your assignment, and I believe that was chapter 14th. Let me see in the chapter 14th. There was something at the very end. Not the statement of retained earnings. Was it the statement of retained earnings? Somebody of you sent me email about something that we didn't cover. And that was the income statement and errors. Correct? Let's quickly go over those one. Just very quickly. So from the set of the financial statements, that will be chapter 14, slides 41. 39 all the way to the end. So for the set of the financial statements that we have to prepare, there are 5 financial statements that we have to prepare. Statement of income, statement of the shareholders' equity, balance sheet, statement of cash flow, and the last one is notes to financial statements. We always going to start with the income statement. Why income statement? Because every owner of the company, every shareholders, every investors, every creditors, the simple that they're going to ask is how much income the company has. So the income statement is the first statement that we prepare. Measure the success of the company, shows you are you building assets and creating shareholders equity. That's how you're going to attract the new investors. That's how you're going to attract the new creditors. Everybody want to see, do you have ability to generate income? From where that income is going to come? From sales. Sales is the first thing that you're always going to see on the statement of income. And after that is downhill. First, you're going to see cost of goods sold if you are manufacturing company or merchandising company. Even if you service company, still going to have cost of goods sold. Then you're going to see the gross margin. And after that, start the operating expenses. Those are usually either listed by nature, either listed by function. Then you're going to have section which is related to the gain and losses until you come to the point that you have income tax expense. Once you show income tax expense, then you're going to show income from continuing operation. And that's the continuing operation income. After that, once you show income tax expense, if you have discontinued operations, you cannot have another income tax expense line. Every income statement have only one and one income tax expense line. So how you have to show all the discontinued operation? Net of taxes. Continuing operation will be normal operation of the business. Discontinued operation will be something that is not going to be repeated anymore. For that reason, all the discontinued operation are shown as a net of taxes. That's for the income statement. Statement of retained earnings is the second statement that we're preparing. Why do we need that statement? To see what's happened with the shareholders' capital. Was it increased? Was it decreased? What increasing it? What decreasing it? Statement of shareholders' equity usually starts different way. Starts with the beginning balance and end up with the ending balance. We adding net income and deducting dividend or net loss if there's any. And that will be the statement of the retained earnings. As you remember, statement of the equity section of the balance sheet have two components. One is the contributed capital, the other one is the retained earnings. Retained earnings is the earning or the net income which is retained over the life of the company in the company. So the retained earnings is always going to have a beginning balance. If it's this the first year of operation of the company, the balance will be zero. After that, it's going to start accumulating the income if there's income. Net income is going to come as an increase of the retained earnings. Dividend is going to come as a decrease of the retained earnings. Statement of equity, shareholders' equity. Now, what you have to keep in mind is that you're going to show you all the transactions that happen in the company during the period of 1 year of the reporting period. Start with the balances of the common shares, contributed surplus, if there are any, retained earnings, total shareholders' equity. And in this case, you're listing the events on the horizontal lines and doing the vertical calculation. At the end of the day, on the very right side, you're going to see the total, which total is computation between the, in this case, common shares, contributed surplus, retained earnings. Now, what's going to happen if there's changes in the accounting policy or any mistakes? Now, if there's a change in the accounting policy and we have any errors, we're going to adjust directly the retained earnings. We're not going to change the net income because, as we already know, if the mistake affecting the income, then we're not going to go and change the income. We already know the income flows into the retained earnings. For that reason, we're going to just go to the retained earnings and we're going to just adjust the retained earnings. Now, the retained earnings will be adjusted if we have mistakes from the previous period that hasn't been corrected yet, and when we have a change in the accounting policy. If we have a changes in estimates, they're not reflecting retrospectively, so we don't have to go back and change the retained earnings. So what you have to remember is only for mistakes and changes that we're going back in the past, we make adjustment for the retained earnings. For any changes that we're going forward, there's no change, there's no reflect on the retained earnings. Example here is corporation recorded a closing inventory balance of $30,000 for 2016. Accidentally, they found a mistake and they found that the inventory, it wasn't 30,000, it was $40,000. So what do we have to do? We have to go directly to just the retained earnings. So we have to put the inventory back in the inventory. And in this case, we're going to debit the retained earnings. If we have that change of the mistake, so how this going to look like? Well, we're going to start with the retained earnings in the beginning of the year, 390. Then we're going to make the adjustment. Then we're going to record the adjustment for the previous year, which is 2016. And then we're going to show our retained earning balance, which is now adjusted at the beginning of the year. And then we're going to follow the normal process, adding the net income, deducting the dividend declared, and we're going to see how much the retained earnings left. Can we have any restrictions on the retained earnings? Yes, we have. Yes, we can. Who's going to put a restriction on the retained earnings? They might be imposed legally through the contracts that the company signed, or can be voluntary. The management of the company decides to keep the retained earnings for some future expansion. That will be called appropriation. What's the example for the legally restriction on the retained earnings? Well, as we already know, the dividend comes from the retained earnings. Dividend is not expense for the company. That dividend comes from the retained earnings. If the company, for example, if the company borrow $1 million from the creditor, well, the creditor now he wants his money back. If you're the creditor, and you just lend the company $1 million, would you be happy, or would you be okay if the company start declaring dividend to the shareholders? What do you say? Obviously, you're not. Then what do you want? You want if the company generate income and generate retained earnings, with that retained earnings, they to pay my loan back, not to give themselves a dividend. I'm not comfortable giving them $1 million because they have a financial crisis or whatever for reason they need the cash, and after that they giving themselves a dividend with my money. Or instead of paying me interest, they to give themselves dividend. For that reason, most of the times the creditors of the company putting that legal restrictions on the dividend. And that's the missing part here for the accounting errors, income statement, statement of owner's equity. Now, we can start with next chapter, which is chapter That will be chapter 11. And that will be the last chapter that we're going to cover before the midterm. So how many times are we going to meet each other before the midterm break? 2 more times. So today I'm going to start liability, current liability payroll. Most likely I won't be able to finish that current liability, but that's okay because we're going to have for next time, which is February 3rd. And the February 3rd and February 10th, we're going to do midterm exam preparation. Make sense?